Welcome to the GCV Weekly Briefing podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew, and this week we'll be looking into the scrutiny of the National Wealth Fund, as well as ISA reforms, signs of retail recovery, and a growing tax concentration among the UK's wealthiest individuals. We start here with the National Wealth Fund, a flagship policy launched by the Chancellor last year to, in his words, rebuild Britain and make every part of the country better off. But a recent report from the Treasury Select Committee suggests that the fund may be too small to deliver on that ambition. MPs said that the fund could help specific sectors, particularly clean energy, but warned that its overall impact on growth was likely to be limited. The issue isn't just scale, it's structure. The committee highlighted a growing problem of fragmentation across the UK's public investment landscape. There are now dozens of overlapping schemes, leaving firms unsure for which to approach. Siemens, for example, said that companies in offshore wind alone face 23 different funding routes. Former NFW chief John Flint said that the situation is getting worse, not better, and called for consolidation to avoid duplication and confusion. One proposal is to merge the British Business Bank with the National Wealth Fund, creating one single, streamlined vehicle to deliver public investment and to attract private capital. Without that, MPs warned both institutions risk wasteful duplication. They also raised concern about the name itself. Unlike Norway's sovereign wealth fund, which is backed by oil and gas profits, the UK's version is funded through borrowing. This raises questions about sustainability and whether wealth fund is even the right term at all. Still, the committee wasn't entirely dismissive. They urged the Chancellor to ensure the fund takes calculated risks to prove its worth. As Dame Meg Hiller, who chairs the committee, put it, the National Wealth Fund has the potential to make a positive contribution to sectors and the economy more widely. But for it to do so, the government must accept and encourage the fund to take risks, even though that might lead to individual projects failing. The NWF must be bold and take on riskier investments, which open the door for the private sector to get involved. It's a fair point. A cautious approach may keep loss low, but it also limits impact. Now, the Treasury, where reports suggest that Chancellor Rachel Reeves is considering cutting the annual tax-free allowance for the cash ISA from $20,000 to $10,000. The idea is to be aimed at encouraging more investment into UK equities, but critics say it could do more harm than good. The Treasury Select Committee warned that it might fail to change saver behaviour and could even reduce competition in mortgage markets. That's because building societies rely heavily on ISA deposits to fund lending. According to Building Societies Association, 2/5, about 39%, of the sector's £485 billion in mortgage lending comes from ISA-backed deposits. If the allowance were to be halved, the BSA estimates mortgage supply could fall by up to 5%, which equates to around 17,000 fewer mortgages. In a worst-case scenario, that number could be closer to 60,000. This isn't just a lending issue, it's a growth issue. The BSA warns that a drop in mortgage availability could shrink GDP by $7 billion over 5 years and cut tax revenues by $2.5 billion. The government's broader goal to get more people investing also does look a little bit shaky. A Finder survey found that only 20% of Brits would move their money into stocks and shares ISAs if the cash ISA allowance was reduced. Most said they'd keep it in standard accounts or simply spend it. Reeves has said she wants to get the balance right between savings and investment incentives, but industry figures remain unconvinced. Tom Shelby from AJ Bell called the idea of mandating UK stock allocations within ISAs hugely complicated, costly, and with no obvious benefit to anyone. And as Sweeney summed it up, tinkering with the ISA allowance isn't going to lead to a cultural or behavioural change that would lead to more Brits investing. Instead, we need better financial education for adults and the younger generation about the possible long-term benefits of investing. It's a reminder that the behavioural change can't be forced through policy tweaks alone. Confidence and understanding matter just as much. Next, some encouraging data from the retail sector. UK retail sales rose 0.5% in September, surprising analysts who expected a decline. It's the second month of consecutive growth, with annual sales now up 1.5%. This suggests that households are slowly regaining spending power after a longer period of financial pressure. The recovery was broad-based, but particularly strong in discretionary categories like clothing, footwear, and technology. Clothing and footwear sales were up 4.4% in the third quarter, while non-food stores saw a 0.9% monthly rise. Food sales, however, stayed subdued, showing that consumers are still price conscious on essentials. It seems many households are cutting back in some areas, while allowing themselves small treats elsewhere, a sign of selective confidence. Online sales continue to grow, marking their 8th straight monthly rise in September, up 3.5% over the quarter and 5% on year-on-year. 8th straight monthly rise in September, up 3.5% over the quarter and 5% year-on-year. Online jewellers have benefited in particular, helped by growing interest in gold, both as a luxury item and as a hedge against inflation. There are also signs that consumer sentiment is improving more broadly. GfK's Consumer Confidence Index rose to -17 in October, up from -20 the month before, with big ticket purchases at the highest in nearly 4 years. Confidence is still below pre-pandemic levels, but the steady climb suggests households are beginning to look beyond immediate financial pressures, and that could feed into a stronger spending ahead of Christmas. Finally, new data from HMRC, obtained by Wealth Club, shows just how dependent the UK has become on its top earners. The top 1% of taxpayers now contribute to around a third of all income and capital gains tax collected here in the UK. That's around 500,000 individuals paying 93.8 billion, up nearly 4 billion on the previous year. The concentration becomes even clearer when you look at the higher scale. The wealthiest 100,000 taxpayers contributed nearly 55 billion, 90% of the total. And the top 100 taxpayers alone paid 1.4 billion, which is more than the entire NHS capital budget for England. Wealth Club's founder, Alex Davies, warned that the government's increasing reliance on this group could be risky. He said a very small group of individuals is responsible for a disproportionately large share of the nation's revenue. If just a handful of these wealth creators were to leave, the fiscal impact would both be immediate and severe. Rather than penalising success, we should be creating a stable and attractive environment where entrepreneurs and wealth generators choose to remain, invest, and contribute to the nation's long-term success. That message ties neatly into the wider policy debate, particularly around the National Wealth Fund and potential tax reforms. The government is walking on a fine line. It wants to raise revenue and invest in growth, but it also needs to keep high earners and investors engaged in the UK economy. So, what stood out most this week? Well, for me, it's the reoccurring theme of fragmentation, especially when it comes to public investment. Combining or simplifying some of these schemes could make the system more effective and improve outcomes for businesses and taxpayers too. That's all for today's update. Thank you very much for listening.